good question. Yes, it is. It's a new investment opportunity, I guess, for a lot of the investors, especially from the institutional investor side of the market. What we have is a market that now is trying to bring together the buy side, which is essentially our pension fund markets, and of course the corporate side, which is now coming principally on the back of the banks themselves. So the issue for us at this point in time is to look at the amount of capacity in the buy side and the absorption capacity for all the institutions in terms of, do they have the amount to absorb somewhere in the region of, we're thinking somewhere about 1.5, probably 2 trillion over the next, say, 2 years. And that's just one issue. The other issue, of course, is to do with the concentration with respect to a huge amount of the issuance coming from the financial sector, and as to whether how well that would sit with respect to the portfolios of these pension funds.
And what kind of room has this left for government bonds in Nigeria?
Sorry, I didn't hear that question.
Just what kind of room is this left for government to actually come into the market and issue bonds? Are they being as aggressive in issuing infrastructure bonds, for example, where we know there are very hefty drives to raise capital to fund infrastructure development moving forward?
That's a good question. I think as at today, the funding for institutions or for the government has predominantly either to do with budget financing or budget deficit financing. There has not been any specific infrastructure bond done by the federal government as at today. There was one, arguably a textile fund that was discussed somewhere a year or two ago, and actually went some way to being issued, but got pulled along the lines. I think the question really is more to do with crowding out, and basically whether the corporate sector would eventually crowd out the government sector. My opinion there is probably not. If you look at today, the last issuance just came, the results just came out. Basically for the 2010 and I believe the 5-year bond, which was all heavily oversubscribed with marginal rates, even for the 20-year bond going as low as 8.37%, which is pretty low. Now that tells me something. It's either that there's a huge flight to quality with respect to monies going to fund to the government sector because of the perception of what's going on in the corporate market, or there is inflationary expectations that essentially say that inflation will drop tremendously over the next 20 years. So from that perspective, I think that as at where we are today, I think it is highly unlikely that you would see the corporate crowd out the government sector, at least as in, I'd say, the near term. As the market evolves and as people become more corporate, well, I'd say more confident or get more comfortable with corporate bonds and corporate spreads and the performance of these paper, then I think you might have a situation where, yes, there is a shift to the corporate side. But at this point in time, there's a lot of caution in the market as to how people approach the corporate cycle. Now, that is one thing to do with the primary sector. There's also things that we're also working on the secondary sector with respect to ensuring that there is a level of liquidity within the secondary market for these corporate bonds that are expected to come to the market over the next, say, 12 to 24 months.
There's a lot of movement and activity around the banking sector right now. At the same time, as we mentioned earlier, we've got UBS, Zenith Bank, GT Bank, First Bank, all forging ahead with these plans to issue corporate bonds. Just what's your overall impression and outlook as far as uptake is concerned on those fronts at a time when investors are still pretty shaky about the standing of these banks right now?
I think that's really the key issue here in terms of the timing, because one of the issues that has been, I think, discussed very deeply is the funding structure of banks and the essentially over-dependence on deposit rates, where even in the market today, you have AAA rated banks issuing or asking or being prepared to pay up to 15% or more for a one-year deposit. And the issue has been, okay, well, we need to look at the funding structure of institutions, and therefore this is a good time, quite frankly, for banks to move towards things like lower tier 2 financing, which is generally common in most other markets. I guess the problem we have is just the timing, because post the bank, when I use the equity splurge over the last 2-3 years, the question on every investor today is, well, what was that money used for, and why should we be putting more money into the same sector? Nevertheless, what we should also, I guess, bear in mind is that generally across board, with the very strong institutions, lower tier 2 or let me call it bank subordinated debt, generally speaking, has proved to be a very good investment to investors, and therefore my recommendation would be that investors, be it institutional, which are generally speaking the target market for the advisors to these banks, should essentially do their homework, do their fundamental work in terms of the credit analysis of these banks before putting money into them. Obviously, I guess the other issue is to do with the concentration levels, because we would look to have a much more diversified bond market, whereby you do not have the same sort of concentration levels you have in the equity market, where about 60 or more % of the equity market today is dominated by banks. If you have the same issue also in the bond market, then again, I think I can certainly see the pension funds, which are the buy side, certainly having some issues with respect to concentration risk.